why haven't we seen a more aggressive stance from the OEMs? I don't know. It's my answer. If I was Volkswagen or Ford or General Motors, I'd be panicking.
Welcome back to Rockstock Channel, and thanks for checking in. Before we launch into the interview, we'd like to thank all our Patreon sponsors. And for those of you who are new, share a bit about us. RK Equity is an advisory firm run by Rodney Hooper and me, Howard Klein. We are exclusively focused on raising awareness about companies producing or developing the next generation critical raw materials that are powering Tesla's EV battery energy transition. Please register your email at rkequity.com and follow Rodney and me on LinkedIn and Twitter. Please also subscribe to this channel, Rockstock Channel on YouTube, as well as Lithium Ion Rocks on SoundCloud for our podcasts. Please note, Rodney and me are not financial advisors or broker-dealers. Nothing you hear in this video is investment advice. Please do your own research and read the disclaimer at the end of this video or on our website. Thanks again for the support, and let's get into the video.
Welcome to Rockstock Channel. It is September 1st. We're getting prepared to go back to school in America and end our summer here, but it's winter in Sydney, and we are very privileged to have Reg Spencer of Canaccord Genuity, one of the leading analysts from perhaps, the leading investment bank and broker and capital raiser to almost all lithium financings over the last 10 years. We interviewed you last, Reg, about 2 years ago, right after the Fast Market Santiago conference, when the tenor was the sounds of silence from Paul Simon, hello darkness, my old friend. So it's a bit different narrative today, and you just came out with an aggressively positive note. Every 6 months you're publishing updates. You called the bottom this time last year. You were increasingly bullish in February, and now taking a page from Tesla's Plaid, you're talking about a Plaid acceleration in the lithium market. So I have a bunch of slides which we'll put on the screen as you're talking, but why don't you just lay out a bit your thesis and just your background. I mean, you're the head of metals and mining, just a bit of Canaccord's franchise in lithium, and your team members.
I've been at Canaccord for 12 years now, currently the head of the mining research team, and between Australia, the United Kingdom and Canada, we have about 15 or 16 publishing analysts covering everything from precious metals, base, uranium and specialty minerals and metals. And as you point out, one of the key areas of focus for us more recently has been lithium, and to a broader extent, battery materials. We consider ourselves to be quite dynamic. We like to think that we have a pulse of the market, and we watch what's happening and we've been covering Orocobre for many a year, and in covering that company, forced us into looking more deeply at what was going on in lithium, and that got us a little bit excited about the outlook for it, and that's really what caused or drove our entry into coverage of that particular sector. So I've been covering the sector now for 6 or 7 years. More recently, as you point out, what we said in September last year was that it couldn't get any worse. You had companies that were selling product for prices below the marginal cost of production. You had a cumulative 450,000 tonnes of probable or potential new capacity that had been deferred, cancelled or delayed. Those kinds of things are classic bottom of the cycle signals. So notwithstanding that, we also knew that Elon was coming out the following week with his battery day. So we knew he was going to say something controversial or exciting. So it wasn't completely by accident or by design. But I think what's surprised us most in the last 12 months is the violence of the re-rate. If you go back to what we said in September, we said, things are starting to look better. EV sales figures are starting to pick up. By the end of 2021 into 2022, we might start to see some improved market conditions and higher pricing. Well, that kind of all happened within 5 or 6 months. And then by February of this year, it was pretty evident that there was a major recovery taking place. On the demand side, you saw a 50% year-on-year increase in EV sales in 2020. And then those 2 years of down cycle through 19 and 20 actually sowed the seeds of what we're seeing in terms of the constraints on supply today. And that's why we're seeing pricing respond in the fashion that it is. Look, a lot of those tighter markets were driven by some M&A activity. Obviously Pilbara and Altura were a big cause of what's happened in the spodumene market, and likewise Albemarle and MinRes. But what we see today is a market that's significantly tighter, and it's becoming more obvious that the supply side does look like it's going to struggle to maintain pace with demand, and that really supports our bullish long-term view.
That's one of the things I noticed in what you were saying is that you see a potential surplus of capacity of hydroxide conversion in China. The shortage of spodumene is not because there's a shortage of spodumene, but it's because it's tied up, in disciplined, integrated, projects.
The way we look at the spodumene market is a little different than the way others might look at it. We don't see a spodumene market. We see a what we call an integrated market, where you've got some very large deposits that are owned by some very well-capitalized companies that plan to feed the concentrate produced from those mines into their own integrated converters. And then on the flip side, you have your what we call independent. So we have a merchant converter fleet in China who will buy concentrate from a number of independent concentrate producers. Today, all of them are located in Australia. Now, when you bundle all that up together, you have a global spodumene supply and demand model. And prima facie, on face value, it might look like that the spodumene market is in balance or even in surplus. And the way we look at that is looking at overall spodumene production versus effective converter capacity. But when you split out the fact that a lot of these bigger integrated companies are unlikely to ever sell spodumene into the market, and Albemarle have said themselves, we won't switch Wodgina on until we have our own Chinese converters to put it into. You look at the spodumene being produced by the independent producers versus the demand from those independent converters. And that is where we see the big deficit. And that is where you see it manifesting itself in pricing now, which is, about $1,000 a tonne. So that, the time we've spent to try to understand the dynamics of the market, I believe is why we've come to the conclusions that we have. But in the longer term, it is naive to think that high pricing doesn't elicit a supply response in any commodity market. And where I differ from other analysts that look at this sector is that, while certainly I don't disagree that the lithium market displays characteristics more akin to specialty chemicals, it also displays many characteristics that make it like a normal commodity. And so in an undersupplied market, for an example, I don't believe you're going to see much of a disparity or a delta between demand for battery grade and, say, non-battery grade. In an undersupplied market, the pricing incentive is there to take that ton of technical grade product and refine it or upgrade it into battery grade. And the best example I can use of that is Orocobre. It's 2017. We know that they had struggled to produce battery spec material, and they were selling product in that particular market at one point for $18,000 a tonne.
China spot versus contracted pricing, there's still a big differential, and we're not seeing the cash flows come through to the incumbents yet. Now, those will be reset. So unless, I guess shareholders or external investors take the view, build it and they will come, or which way around you do it, someone needs to take responsibility for that investment. And at the moment, the cash flows aren't quite there. So whose responsibility is that, in your opinion?
Well, it has to be the people that need the material the most at the end of the day. And I think, we'd all agree on this point. If it's the auto OEMs that are in most need of significant increases in supply, we need to really start seeing those guys write checks and start to invest further upstream than what they have in order to foster that additional capacity. While the equity market more recently and capital markets more recently have shown a willingness to invest in new projects, it still pales into insignificance that the quantum that's required over the next decade in order for supply to meet demand. So we're going to need to see either your OEMs come to the party, or the involvement of your larger, very well capitalized, diversified mining companies like your BHPs, your Rios, your Fortescues, for example, come to the party and help bring that supply on in the long term. Otherwise, and this is something that I see as the biggest risk to our investment case, is not so much an oversupply, but an undersupply. Because of the way that we look at the market now, there's not going to be enough lithium, which means that you can't make the batteries, which means you can't sell the EVs. So while we model a 40% EV penetration rate in 2030, the way it looks today is it's going to get nowhere near that.
Do we run a risk, aside from the chip shortage, that could high lithium prices and other battery metal prices put a kibosh on the dropping average cost per kilowatt hour, and then extending on that, EV penetration?
We've done a lot of work trying to understand the dynamics of the raw material markets relative to the cost of the batteries, and what it means for the OEMs, and how that affects their ability to make a profit. It's very interesting, and to see that we are seeing some regionalisation is probably where I'm going with this. You're seeing more of the stick approach in places like Europe. That compares to more of the carrot approach that we saw in China a couple of years ago with their very generous subsidies. And then the United States is kind of somewhere in the middle. I don't think that your major European OEMs are going to have a choice if the EU is going to comply with their Paris Accord obligations. You've got carbon adjustment border mechanisms coming into Europe over the next few years, which is just going to make things more difficult for the OEMs. So I think, to answer your question, I think where we're pointing to is that the big companies and the car companies they're not going to have much of a choice if they're going to achieve their targets. Now, one other factor of this sector that stands out to me is the poor track record of the lithium industry in being able to deliver. In our latest research, we lay it out in a couple of charts, and the average delay from when a new project was originally slated to come online to when it actually was, for projects that are currently in production, is almost 2 years. And then if you have a look at planned projects, the delay stretches from 3 to 4 years. So even if the capital was available today, the complexity and the technical difficulties of these projects do not lend themselves to immediate supply responses. So you have a confluence of factors, be it underinvestment, high technical risk, high capital intensity, not an obvious willingness from your better capitalized customers or end customers to want to invest in the upstream. It kind of does create a little bit of a perfect storm for pricing, and I think we're starting to see a little bit of that play out at the moment.
We've got nothing immediate coming online. SQM's running as hard as it can. I made a forecast after their Q1 was higher than theirs for the year. Now they're matching my forecast because everyone wants everything they can get their hands on, and you're right. Whatever quality, it doesn't matter. But we're August, and we're already, SP Platts is already showing over $20,000 a ton for carbonate and hydroxide. So how high can this thing go? At the rate we're going before year end, where could we could see an eye-watering number.
Yeah, well, it's possible. And then we start to think about analogies to that. And I think about rare earths in 2011. If we see pricing go too crazy, it will lead to demand destruction or the risk of substitution. The car companies will have no choice but to continue to produce ICEs, and they are powerful groups with big employers in Europe. And the governments there may soften their stance a little bit, or have to take a step back on their aggressive emissions targets. So super high pricing doesn't help anyone, in my opinion. And I will use rare earths as the prime example of that. But again, it would be naive to think that high pricing doesn't elicit a supply response. And at $1,000 a ton for spodumene, there aren't many hard rock projects around the world that don't work at that level. And then also, if we have a look at projects that are capable of bringing on large tons into the market, like Wodgina, you have to kind of think, if you're Albemarle, geez, $1,000 a ton, that seems to be has to be pretty attractive, whether or not we have our own conversion capacity to put it into.
Which was funny enough, the question I was going to ask, is there something that can trigger this? Because at those prices, it's hugely profitable. I mean, Chris Ellison must be champing at the bit.
It's the biggest risk we see in the short term to the spodumene price. Is Wodgina. It is a huge project. 750,000 tons of capacity. Trains 1 and 2 are ready to go, and so we often sit there any day and wonder, will Albemarle switch it on? Wodgina does present a risk. There doesn't look to be any other major sources of spodumene on the horizon that could come into the market in the near term to take some pressure off. And as you mentioned, Rodney, as much as Albemarle have the best assets in the world and think strategically and over the long term, they also have shareholders, and they also have earnings targets, and the prospect of being able to generate a margin of $700 a ton on spodumene, has to be pretty attractive, you'd like to think. So, but on the flip side, Australia is a very difficult place to be operating at the moment with respect to the mining industry. We have closed borders, we have significant labour availability issues, we have cost inflation, we have capital cost inflation. If Albemarle decided to turn on Wodgina tomorrow, it's not that apparent where they're going to find 300 people to operate that mine. Another example is the fact that Albemarle have pushed back their timeline on Kemerton, because they can't get the people. So, while we are cautious around the potential for a supply response, because pricing is doing what it's doing, there are a number of reasons why an immediate supply response may not be forthcoming. And so that's why we're quite comfortable in terms of our medium-term view on the tightness of the market.
Why do you think it's taking so long for Albemarle to buy conversion in China?
Because all the good ones are owned by other people. The converter fleet in China, if we go back, and it's only not so long ago, there was 3 or 4 modern facilities that were able to operate on a continuous basis that had higher rates of utilization, and a lot of the other facilities in China were run by poorly capitalized companies. They had low utilization rates. And that situation has only just started to change, where you've got now seeing the entrance of much larger, better capitalized companies. The IP has improved, where these groups know how to operate these plants better. They have more consistent feed, so on and so forth. But the reality is that Albemarle hasn't been able to buy one because there hasn't been one for sale. If you have a look at some of the new capacity coming online from some of these better operators in China, like a Yahua or a General Lithium or a Yibin Tianyi, they're not going to sell their converters to Albemarle. So I think it's a case of if Albemarle want a facility that's going to be of sufficient quality, they're going to have to build it. They're not going to be able to buy it for a price that might be seen as reasonable. And furthermore, other Chinese groups which are integral into China's domestic EV market going to let go of some of the control that they have over their own supply chain. So I'm not necessarily convinced that Albemarle are just going to be able to find one to buy. But they may prove me wrong, and time will tell. If they can't find it, maybe we do see Wodgina selling spodumene. I think maybe only Albemarle knows the answer to that question.
Or longer term, you've got spodumene at 750 and chemical prices around 15s. In my mind, I think 750 pretty much most spodumene projects work. Are you expecting then to see quite a bit come online then, sort of in the medium longer term?
Yeah, look, I think if anyone tells you that they know what's going to happen in 2030 is either lying or doesn't know what they're talking about.
Well, they've got 9 years to be right, isn't it?
Look, I've been a mining analyst for 15 years, and geez, I think a forecast anything further than 12 months out is fraught with danger and difficulty. Just go back to what we said 12 months ago. Look, we take a relatively conservative view to our long-term pricing assumptions. The reality is, if you have a look at our supply-demand curves, we're forecasting a 1 million tonne LCE deficit by 2030. If that plays out, pricing is not going to be $15,000 a tonne. We know that. That long-term pricing is really an assumption that we use on the basis, what price would you need to deliver a sensible IRR for a greenfield project?
I think 15 is a great long-term price. I think, rightly or wrongly, people will plow money into the business if they think they can get that as their sell price.
What's become a little bit more apparent in the last few months, and the guys at Pilbara have done a good job in explaining this, is that because the power in the market has now shifted back to the producer and the seller, there is the ability for the concentrate producers to capture more of that margin. That $750, if you've got a $15,000 a tonne long-term pricing, and if the market's in deficit and you've got a large independent converter fleet that's undersupplied, they're going to have no choice but to pay more than $750 a tonne, just like you're seeing in the market today. So, one of the conclusions that we came to in our most recent research was that, whereas we previously saw deficits emerging in 23, 24, there's been a significant change in the dynamics of the market, such that those deficits are in the market today. But because we're starting to see that manifest itself in pricing today, that's going to bring forward some supply that we had pushed out to the late 2020. I think if you think the market stays tight and demand stays strong, and prices stay up here, then there will be some supply come to the market.
In your research, you were using like $15,000 capital intensity per ton as a typical, metric, but that seems low from a non-China perspective.
The capital intensity of Mount Holland is a reflection of the current market in Australia, and just the higher costs associated with building a project in Australia. A lot of new supply that's likely to come into the market over the next 10 years are going to be brownfield expansions, which typically carry a significantly lower capital intensity than a greenfield project. Have a look at how much SQM is spending on taking capacity in the Atacama from 80,000 to 120 up to 180. It's certainly not $30,000 a tonne or even $20,000 a tonne. And similarly, if you have a look at the incremental capacity of Pilbara is able to bring into the market, or CGP2 or CGP3 at Greenbushes, the capital intensity of those brownfield expansions are relatively low. But the trends that we have seen since we last did that exercise is that capital intensities are going up. The average capital intensity of a brine project, a greenfield brine project, was about $15,000 a tonne last time we did the work. It's now 20. And for a integrated hard rock lithium hydroxide project, for example, the average was about $20,000. It's now something closer to 30. To answer your question, I think we have to be cognizant of the ability for brownfield expansions of incumbent and existing production, but also new projects and new supply is getting more expensive to build. So that's kind of why we're somewhere in the middle a little bit with our average capital intensity calculations.
Outside of Western Australia and hard rock going into China, how do you view the European and North American scene?
At the end of the day, we're going to need every single tonne of lithium chemical supply that we can get our hands on if supply is going to meet demand over the long term. And frankly, to solve that conundrum about long-term or perpetual deficits, as some have called it, the industry is going to need a step change or a leap in new processing technology in order to bring on large volumes at relatively low capital costs. Now, that's, as it stands today, technologies don't necessarily lend themselves to that, but we are seeing certainly some advancements, and as you call them, unconventional projects sort of coming to the fore. But if we have a look at projects that are conventional projects and the issues that they've had, I think one would be naive to think that every new project looking at a novel process or a new technology would come online on a shorter period of time. The reality is over the near term, it will be conventional projects, it will be your brines, it will be your hard rocks that are going to do the heavy lifting with respect to delivering new supply. But in the back half of this decade is hopefully when we start to see some of these newer forms of production, hopefully, and I'm going to say hopefully, come to the fore because we will need them. Whether they're clays like you got in Nevada, or whether they're geothermal brines like you've got in Germany or even California, or the employment or adoption of direct lithium extraction on lower quality or lower grade brines in South America.
One of the jurisdictions where they seem keen on mining and they're pro it and supportive and it could help out there is Canada with the spodumene. It's clean energy. The Quebec government and Canadian government is very pro. Your thoughts on that?
I'm quite excited about Canadian lithium, I should say. We know that there is a lot of scar tissue attached to Canadian lithium projects, Nemaska and before that NAL. But it is going to play a very important role in helping supply North America's needs. And for those very reasons you said, you have access to a skilled workforce. It is a mining country by definition. You have cheap, low cost, low carbon energy sources, especially in Quebec. And those are the kind of characteristics that make it almost a perfect jurisdiction or destination to be looking at a new project. And it just so happens Quebec has a bunch of undeveloped projects that are now starting to come to the fore. You've got Livent and Pallinghurst, obviously, there that have now got their hands on the old Nemaska assets. You've got Sayona and Piedmont that have now got their hands on the old NAL. You've got Orocobre at James Bay. Then you've got a raft of other smaller groups that are looking at developing or defining new resources in Quebec. So while I see projects in North America as not necessarily being easy to get through the permitting process, this is where places like Canada can fill the breach a little bit. The acquisition of the NAL assets by Sayona and Piedmont, it's quite a unique situation. Everyone's quite familiar as to why NAL failed in the first place, and it's got a lot to do with geology and mineralogy. But the ability for another company to come along with a resource that's proximal to help offset those metallurgical challenges that are presented by the actual original NAL resource, that's quite unique, and that actually placed them in the best spot to be able to make that project work. And I quite like what those guys are doing up there with the help of Piedmont. The reality is that project is actually the most advanced hard rock project in North America. Subject to a little bit of capital spent on the plant, it's fully permitted, it's ready to go. Whereas a lot of the other projects, say, Ioneer or Thacker Pass or some of the other clays in Nevada, it's still only at DFS stage and have got to yet to go through construction and financing. So those guys have done very well, and I quite like what they're doing there. But
Africa, we haven't really talked about yet.
This is another frontier where I think you're going to start to see come to the fore. Goulamina is a high quality asset, which the market only really recognised once Ganfeng came and gave it the tick of approval through their investment. You've got a huge deposit in the middle of the DRC called Monono. That may or may be developed in the near term as well. And then you've got other interesting prospects like Arcadia with Prospect. So look, Africa is certainly going to play its role. While it suffers from the tyranny of distance with respect to these hard rock projects to where all the world's conversion capacity is today, I think what you'll start to see over the next few years is the emergence of a merchant converter fleet located in Europe. We already know of at least 3 facilities that are being planned. And that is the natural home for spodumene being produced in Western Australia West Africa or Southern Africa, just by virtue of its proximity. And so that might help Europe go some way to helping secure some of its requirements. But as it stands today, that's at least a few years away, given where those projects are in their stages of development.
We just had a interview with Garrett Fueling, and we talked about that a bit. And it's a bit of a problem, though. What do you do with all the waste if you don't have a mine to put it back into? So it's a bit of a problem on the hard rock merchant converter. Although, do you have any view on this Metso Outotec process that's different from what's used in China and what's used in Western Australia as a means? Piedmont's using it, Caliber's using it, Critical Elements, Holmec. Any view on that?
Yeah, that's an interesting point. And one thing we haven't talked about so far is the emerging role that sustainability is going to have on the whole supply chain. The carbon intensity of lithium production is very much front of mind for the end users, as is the rest of their supply chain. So if you're a Volkswagen or a Daimler or a BMW, and you're buying lithium chemicals out of China that have been produced from spodumene in Australia, then shipped halfway around the world, is that the most sustainable supply chain you can have? And so this is where we see some regionalisation of lithium chemical supply in order to reduce the carbon intensity of the chemicals and the products that the OEMs are looking to produce at the end of the day. But with respect to the Metso Outotec process, look, from what we've seen and from my reports, it looks like it addresses some of those issues. It's novel, which means it does carry risks. It's yet to be commercialised at any real scale. But the ability to reduce your footprint, reduce your reagent consumption, reduce your energy costs, all of those things contribute to lowering the footprint of a project and the supply chain.
And you talk about sustainability. I mean, Tesla just put out their sustainability report. They're the forefront of sustainability. On the other hand, you have GM, Stellantis, Renault have recently kind of like announced MOUs, not a lot of money, attached to it, but you mentioned the Salton Sea geothermal, and also, in Germany. What do you make of the preference of non-Tesla, right, OEMs, going into unconventional, projects as their lithium solution without really, providing much money? In GM's case, they said, we hope to visit, the Salton Sea, once, COVID allows.
I don't for one second believe that these arrangements that the downstream are striking with some of these companies are their solutions for supply. The way I look at it is that in the not too distant future, long-term security of supply or access to the raw materials is going to become an issue. And so for a Stellantis or a General Motors or an LG Chem, any of these groups striking off-take arrangements today basically puts their foot on that supply over the next 5, 10, 15 or however many years. That, if the project does get up and running in that space of time, then great. But if it doesn't or it takes longer, at least they've still got the optionality of that supply. So I think those companies looking at things like the geothermals or other unconventional projects are looking at them as helping tick that sustainability box. It's helping them achieve their local raw material supply requirements, but it's giving them optionality as much as anything else. But at the same time, I also think it's a tick of credibility for the projects that these companies are working on.
Yeah, it was funny. Right after the Vulcan LG announcement was made, I looked back, 5 years ago and saw a virtually identical agreement LG Chem made with Nemaska. So no money attached, promise and optionality, but lending credibility, in the hopes that they'll otherwise kind of, get financed. But they're not binding commitments. They're much more, I see a big difference between those and and the deal that Tesla struck with Piedmont, which it wasn't for hydroxide or chemicals. It was part of a defined strategy by an OEM, the first to actually get into the lithium processing, lithium chemicals business. Why haven't we seen GM and Volkswagen, et cetera, take those more aggressive steps to get into the business. And, you know, in Tesla's case, they're financing chemical conversion, right? Just they are getting into the business, and they knew that they needed to lock in some spodumene offtake, and they picked, you know, the one that was in America, you know, and it was closest to them. So for their localization and reducing the kilograms per kilometer traveled, you know, to that point. And their chairman, you know, keeps saying that, you know, you don't want to ship these things, you know, 9,000 miles, you know, around the world. But, you know, back in the day, you know, GM owned iron mines, or Ford owned iron mines. They owned rubber plantations. But here they are, you know, it seems virtue signaling, you know, you said checking the sustainability box by, you know, not putting money, but, you know, lending their brand, right, to, you know, an unconventional process, like where, like, why aren't they, you know, financing or aggressively, you know, why might they not partner with, you know, Livent and Pallinghurst, right, or a Cobre, you know, or any of the other Canadian projects that we're talking about?
Why haven't we seen a more aggressive stance from the OEMs? I don't know. It's my answer. If I was Volkswagen or Ford or General Motors, I'd be panicking today. I'd be looking at well, just in the Western OEMs, you know, in excess of $250 billion of investment announced into electrification over the next 10 years, and yet $0 committed to securing upstream raw material supply. There's quite a big gap that needs to be filled there. But then when you think about, you know, those estimates, when we talked about capital intensity and before, and how much capital we think is required in order for supply to meet, you know, demand in 10 years' time, you know, $35 billion out of 250 or 300 actually doesn't seem like that much. So I think now that the OEMs have decided upon their strategies towards electrification, they've earmarked what their requirements are for their battery capacity. They've decided where they're going to build it. They've decided what they're going to build. They've decided what they're going to put in the batteries. I think going forward, we may start to see them be a little bit more aggressive and a little bit more forthright in moving upstream. And especially after the likes of Tesla's Battery Day and Volkswagen's Power Day and Stellantis's Day that they had as well. You know, they've now laid out their strategies, and it's all about backfilling that now, I think. So going forward, I expect to see some involvement of OEMs in the upstream raw material supply chain. When and who and in what form, I'd only be speculating, but it has to come sooner rather than later.